Transition from property structure to financial performance. In Section 10.2, we structured the property, purchase price, fixtures, and possession. Now we move into the engine that determines whether escrow actually closes, financing. In the metropolitan Phoenix market, more transactions fail due to financing breakdown than property condition. Section 2 of the contract is a timeline-driven performance section. It allocates risk between buyer and seller with precision. Financing obligations tie directly to professional conduct and supervision duties. Agents must understand these timelines to protect their clients and avoid misrepresentation. This section is not just about loans. It is about compliance, diligence, and enforceable performance standards. Pre-qualification, foundation of financing representation. The contract requires that an AAR pre-qualification form be attached and incorporated by reference. This document establishes the buyer's loan type, loan amount, down payment structure, and lender identity. Phoenix example. A buyer submits an offer in Chandler stating conventional financing with 20% down. After acceptance, buyer switches to FHA with 3.5% down without notice. This may materially affect appraisal standards, property condition requirements, and seller risk. The pre-qualification form is not marketing material. It becomes a contractual representation. Loan contingency. Approval without PTD conditions. The buyer's obligation to complete the sale is contingent upon obtaining loan approval without prior to document conditions no later than 3 days prior to the COE date. This language is critical. Approval must be clean. Approval subject to additional underwriting conditions does not satisfy the contingency. Buyer must, no later than 3 days prior to COE, sign all loan documents, deliver notice of loan approval without PTD conditions and date of receipt of closing disclosure, or deliver notice of inability to obtain loan approval. This structure prevents last-minute surprises. Scottsdale example buyer believes they are approved. However, lender approval is subject to verification of employment and final asset documentation. These are PTD conditions. If not cleared 3 days prior to COE, the buyer has not satisfied the contingency. Understanding this language separates professional agents from transactional order takers. Unfulfilled loan contingency. Earnest money protection. If after diligent and good faith effort, the buyer cannot obtain loan approval without PTD conditions and delivers notice no later than 3 days prior to COE, the contract cancels and earnest money is returned. However, if buyer fails to provide notice, seller may issue a cure notice. If buyer breaches, seller may claim the earnest money. Gilbert example. Buyer's lender denies loan due to debt-to-income ratios 2 days before COE. Buyer fails to send written notice. Seller issues cure notice. If buyer does not cure or deliver inability notice within cure period, earnest money may be forfeited. Notice timing controls outcome. Interest rate and necessary funds. What is not an unfulfilled contingency? The contract specifically states that failure to lock the interest rate or failure to have necessary down payment funds is not an unfulfilled loan contingency. Mesa example. Buyer chooses not to lock rate. Rates rise. Payment increases beyond buyer comfort. Buyer cannot cancel under loan contingency because the inability is self-created. Queen Creek example. Buyer intended to use bonus funds for down payment. Bonus is delayed. Lack of funds does not qualify as failed loan contingency. This clause prevents strategic cancellation. Loan status update, transparency requirement. Buyer must deliver the loan status update within 10 days after contract acceptance and instruct lender to update upon request. The LSU provides seller transparency and confirms that the loan is moving through underwriting. In competitive Phoenix markets, listing agents monitor LSU carefully. Tempe example seller cancels showings after acceptance. 10 days later, LSU reveals income documents not submitted. Seller now understands financing risk early enough to issue a cure notice if necessary. The LSU keeps transactions accountable. Loan application, 3-day requirement. Unless previously completed, within 3 days after acceptance, buyer must provide lender with necessary identifying information and authorize credit access. Failure to apply promptly can be evidence of lack of diligent effort. Chandler example. Buyer delays application by a week. Underwriting is delayed. COE extension becomes necessary. Seller may refuse extension if buyer did not act diligently. Loan processing during escrow. Diligent performance. Within 10 days after receipt of the loan estimate, buyer must indicate intent to proceed and provide all requested disclosures and documentation. Buyer agrees to diligently work to obtain loan approval. This is performance language. A buyer who ignores lender document requests risks breaching the contract. Type of financing. Risk profile matters. Financing types include conventional FHA, VA, USDA assumption seller, carryback. Each carries different appraisal and underwriting standards. Peoria. Example VA loan requires termite inspection and specific appraisal repairs. Seller must understand implications before accepting offer. Precision here shapes negotiation leverage. Seller concessions, structured credits. Seller may agree to credit a percentage of purchase price or fixed dollar amount. These concessions may be used for fees, costs, broker compensation, or other expenditures allowed by lender. In the Phoenix Metro, concessions are strategic tools in shifting markets. However, concessions cannot exceed lender guidelines. Glendale example seller agrees to excessive concessions beyond lender limits. Loan must be restructured. Amendment required. Always confirm concession limits with lender. Changes in loan program. Notice requirement. Buyer must notify seller of any change in lender, loan program, or financing terms, and may not change without consent if it adversely affects ability to obtain approval, increases seller costs, or delays COE. Scottsdale example, buyer switches lenders mid-transaction. New lender requires new appraisal. COE delayed. Seller may refuse extension. Transparency prevents conflict. Appraisal contingency. Value protection. Buyer's obligation to close is contingent upon appraisal acceptable to lender for at least purchase price. If appraisal is low, buyer has 5 days after notice to cancel and receive earnest money back or the contingency is waived. Gilbert example, home under contract at $750,000 appraises at $720,000. Buyer may cancel or negotiate price reduction within 5 days. If buyer fails to act within 5 days, contingency is waived. Deadlines matter. Appraisal costs, non-refundable expenses. Initial appraisal fee is non-refundable. If seller pays initial appraisal, contract clarifies whether it applies toward concessions. Updated appraisals are buyer expense. Buyers must understand that cancellation under appraisal contingency does not guarantee refund of appraisal fee. Why does the contract require loan approval without PTD conditions 3 days prior to COE? Answer: to prevent last-minute underwriting surprises and ensure the loan is fully clear to close before recording. If a buyer fails to lock their interest rate and rates increase, can they cancel under the loan contingency? Answer: no. Failure to lock the interest rate is specifically excluded from qualifying as an unfulfilled loan contingency. Why is the loan status update important for sellers in a competitive Phoenix market? Answer: it provides transparency into loan progress and allows the seller to monitor buyer performance before critical deadlines.